Hi, I'm Johanna Botha from StoneX. Financial markets rallied yesterday after President Trump confirmed earlier rumors of a pause in tariffs. However, with China facing increased isolation from the White House, investors are now closely watching to see what happens next. I'm joined by StoneX Global Head of Retail Dealing, Alex Ridgers. Alex, thank you for coming today. So, after all the talk of tariffs, what is next?
Well, this is it. I mean, we can go on all day long about what will happen between China and the US and when that will be resolved. And I don't really think that needs a lot more airtime, if you know what I mean. So looking forward, what's next? If or when the tariff situation calms down, I think we're going back to interest rates. I mean, if we think ever since COVID, interest rates have been the main thing for the financial markets. Again, I mean, in reality, higher interest rates we haven't really seen dampen the indices like we thought we would. But again, as a play, markets are happy when interest rates are low.
But what do you think is going to drive the Feds in their decision making?
Well, I mean, it's interesting and very good that today we've got the consumer price inflation coming out of America. So it comes at a very, again, poignant time where we're looking at long-term interest rates. Everyone's taken a bit of a flight from T-bonds. I mean, they're still the most liquid thing in the world, but so long-term interest rates have sort of firmly hardened, again, gone up. Whereas short-term interest rates, I mean, the changes have been phenomenal. Where we were talking, if we go back to February, we were talking about just over one rate cut predicted before the end of the year. That was 3 at the start of the week. That went to hit a peak of 5, and we're back down to 3 now, sort of after with a bit more settlement. And it hasn't also sort of been just the US. If we look at British bonds, just purely on the back of what Donald Trump's been saying, as recently as the 25th of March, we were looking at, say, 1.6 interest rate cuts, quarter point cuts. We were up to 4 this week, and now we're back down to 3. So these thoughts around, again, what is happening in the interest rate markets, and again, funding of index positions, things like that's again, so that's the dominant thing, which is the consumer price inflation. And to me also, I think we're going to see initial jobless claims, which haven't been that much of note, because everything has been rosy and healthy, particularly in the US economy. So whether there's a few more jobs or a few less hasn't been that important. But again, as a driver of the Fed, 130 once a week, that's going to be a really big driver for any recession.
So going back to recent events, what's market liquidity like?
FX liquidity has really been almost unchanged, and quite surprisingly so. That I think the FX traders, they don't really know what the impact tariffs and recent events are going to have on FX markets and the strength of one currency versus another. So that's pretty much been business as usual. Whereas on the indices, equity indices in particular, we've seen massive changes. I mean, if we think of the DAX has been the strangest market. Most US indices, going back to those, it's sort of been slightly wider. We've seen the S&P, rather than being a quarter point wide, is now a half. But the DAX, where we'd normally see futures tight, 1 pip wide, the minimum tick, the average spreads yesterday were around 12, 15 pips. And that's not just been during the chaos. That's almost been a sort of normal average spread. So I think the market makers have just said, these moves are so big, we're not going to try and keep to a tight spread now. We're just blowing out ridiculously.
And are you seeing significant spread changes for your retail clients?
We've tried to keep spreads and again, market-wide, we tried to keep spreads as normal as we can. We like to give that sort of almost consistency to clients. But where we've seen extreme volatility, we have to just widen, because we hedge a lot of our flows. We have very prudent risk management. So when we're taking lots of deals and on a very tight spread, we've got to then relay those to the market on a wider spread. So as I said, we've tried to keep things as normal as possible, but in extreme events, particularly as I say, like the DAX and like the Nasdaq and the Dow particularly were going very wide yesterday. We just have to be a little bit more cautious.
So how do you think geopolitical tensions are affecting trading strategies right now?
What we've seen over particularly the last week, traditionally, again, clients will get into positions and hold them for days. The average sort of 10-year positions has been a lot longer. Whereas now we've seen clients very active. We've been seeing record volumes this week, but it's rather than the clients holding positions overnight, they really want to get in and out. I think there's that, and I suppose that is sort of what CFDs are there for. There's that safety net, relatively tight spreads that we offer to be able to go in and out and then go to sleep and and sleep safely. Whereas I think before clients were very much happy to open a position, whichever direction, long or short, and then run it for days, weeks. But now it's like, right, I'm getting in, I'm getting out, and then sleeping soundly.
Well, given the last change that just happened and going back to a 90-day pause as of today, that's what's happening, right? 90-day pause. Do you feel like investors can rely on the policies that are not up to date necessarily?
Yes, it's a very good question, and I think again maybe this is what's been driving clients to have shorter term positions, and particularly when we look at again anything Donald Trump says seems to be reversed at the moment. So, while clients obviously have had it's been a bumpy ride, on both sides. All our clients were loaded up for an index rally. Again, they were expecting that Trump to again what he says not to be carried out. And I think it's almost that sort of bargaining chip he uses. In a negotiation, you push hard one way to then come to the middle ground. It's just his sort of he pushes so far that the middle ground is still going to be somewhere over here.
Well, he's hoping that it's closer to his side at the very least.
Yes, exactly. And the sort of the final thing, the trend we're seeing at the moment is, when we think of oil, it's crazy to think of oil back down. We almost touched $55 on the front of the NYMEX crude contract. When in the past you think we've seen we used to over $100, or at least in recent times we've been used to say $70, $75 a barrel. So it's oil's now around $60. So it's in a way it's surprising. It shows you the lasting impacts that even though Trump's reversed most of these strategies, as you said, he usually does, his policy, what he's doing is still having a lasting impact. So our clients are firmly on that. I think it's one of the biggest long positions we've seen in oil now.
Well, thank you, Alex, for joining us, and thank you for watching. Please remember to like and subscribe for more financial content like this.